All right, everybody. So today I'm going to be going over the best risk management framework to make sure that you never blow another account and you are able to use this framework with pretty much any account that you guys are trading. If you guys are going to be on prop firms, that is what I personally trade. So that would be a little bit more catered to that. But as you guys can see, what I'm showing you guys today, this exact framework is what I have used to personally have made $144,000 last month just from trading. As you can see, there are screenshots from my Twitter. If you guys want to go check out my Twitter, I show you guys screenshots of the payouts I take, trades that I take, P&L at the end of every single day. If you guys want to go follow that, go ahead and check that out. Obviously, you guys can see these wires hitting my account are pretty big. That is because I'm trading multiple accounts at once. Right now, I think Apex just extended their sale 80% off on all of their accounts. So if you guys want to go cop some accounts, you can trade up to 20 of them on Apex all at once if you use my code AVAL, 80% off. So there's actually a few different things that we're going to talk about. It's 3 different ways that we can manage our risk. Like I said earlier, it's going to be calculating your sizing per trade, calculating your average trade in ticks, and then also my personal favorite, which I will be getting into soon. Now, for all of these examples that I'm going to be using today, I'll be going based off of a $50,000 account sizes because that is pretty typical for the people that I'm mentoring and the people that are also watching my videos. And so I have the rules laid out for that right here. Again, I'm pretty sure Alpha Futures is also % off with my code AVAL right now. Whatever you guys want to go ahead and do, whatever prop firm you want to use. Alpha is the best one. Apex is the cheapest. Both are in the description with my code. Now, these types of videos, I want them to be very raw, straight to the point, and just free value for you guys. So without further ado, let's get into it. So the first one is going to be calculating your sizing per trade. This means that when you're getting into a trade or you're looking to take a trade, you know the exact dollar amount that you're going to be risking trade. So for the example I put here, I said a $50,000 account. Typically, what you hear people say is 1% risk per trade, which is going to be $500 trade. Now, with this, that means since it's a $50,000 account, you get $2,000 buffer before the account blown, which means that if you're risking $500 per trade, that leaves you with 4 losing trades in a row until the account is blown. So I'm going to go through the other 2, and then we're also going to go through the pros and cons for each and every single one, and which one I would recommend the most. And the next one we're going to talk about is calculating your average size in ticks. So this is going to be a fixed number of contracts. So you're not going for a fixed dollar amount every single time you enter a trade. You're not going, okay, I'm going to enter this trade and I'm going to risk $500 every single trade. You're entering with a fixed contract amount. What that means is some people typically they'll go 5 micros, 8 micros, 1 mini, but that's going to be consistently. You're never changing your contract size. So for example, let's say that your average trade is 150 ticks with a 2-to-1 risk reward, which means that your average loser is probably around the 75 ticks area. Now for this example, I would say if I'm using 1 mini contract for every trade, average loss being 75 ticks, that's going to equal to about $375 per loss. And now it's very important that between these two, there is a big difference with them, but they both work. That is why we're going to go over the pros and cons because this is very important and this can get very, very detailed. So I want to make sure that we're following along for all of this. And then we have my personal favorite, and this is going to be based off of your personal trading data. And I'm pretty sure most of you guys are also going to agree with me. I think that this is by far the best one. This is the one that I personally use. This is the exact method that I used to make over $100,000 last month with trading. For this example, if my longest losing streak ever, let's say for example, it's 8 trades with a $50,000 account, you get that $2,000 buffer. If you take the $2,000 divided by 8, you get $250 worth of risk per trade. So going by this, that means that with whatever buffer you have, you're not going to blow the account unless you manage to have your worst trading streak of all time, which is very unlikely if you are actually trading legitimately. Now, with all this being laid out, I want to go through the pros and cons of every single one of these. So without further ado, let's get into it. Now, with the first example, with calculating your sizing per trade, the pros is that it's very technical and logical. It makes it very easy to follow, and you know exactly when you're going to blow the account. This means that you don't have to guess however many losing trades it's going to take for you to blow the account. So when we're using the 1% per trade, we know that that's $500, which means we have 4 trades until the account is blown. And with that, it leaves very little room for error unless you are just losing your trades back to back to back to back. This is good, but there are a few cons. The cons is you're always going to have to calculate your contract sizing, which means if you're trying to get into a trade quickly, you don't want to have to adjust the contract sizing. You don't want to have to calculate the exact amount of contracts you need to enter with in order to enter on the exact percent that you want to be risking. Also with this, sometimes you're going to have to trade micros, which means if you're trying to take a trade on NQ, you see something that you like, you're going to have to go to a complete different pair just to be able to enter your trade with a certain amount of contract because sometimes the sizing is too big, the price can be too volatile, so you're going to have to switch between pairs. I personally find to be annoying. It's not ideal when you're trying to enter a quick trade. Now with the second option, we have the pros. So with this one, it is based off of your personal data. So you are going to be getting a more unique approach to your risk because it is somewhat based off of your personal data. Why this one I would prefer it over the other one for my personal way that I like to trade is because it makes it very easy to enter without having to calculate. You know exactly how many contracts you're entering with per trade, and that never changes. So whether you're taking a huge trade or a small trade, it allows you to be very versatile because you know exactly how many contracts you're entering with. So there's no guessing, no calculating before you want to enter a trade. If you see something that you like, knowing exactly how many contracts you're entering with, and that you're not going to have to do any second guessing on whether the trade is too big or too small, because it's going to be fluctuating, and that is something that you are aware of. So one of the few cons I have with this one is because you're not going for a certain dollar amount, you can't really calculate exactly how many trades you're going to take before the account is blown. For example, with the first one, we know exactly how many trades it's going to take for us to blow the account if we keep trading a certain amount of trades in a row. We know how that's going to end up. With this one, it is a lot more versatile, but that also means that it's going to be easier to have room for error when you're trying to realize how many trades you're going to take before the account is blown. It could fluctuate a lot. It can go from 3 to even 8 trades, and you have no clue when it's actually going to be blown. Now, for some people, that can be difficult, but not for me because I like to trade with a high win rate, so I'm typically not running into that problem. But that does leave more room for outlier trades that can skew your data. So we can say that it's based off your personal data. If you're not actually trading according to your data that you've previously recorded, it's not going to matter because you're going to have too many outliers to be able to actually calculate what is proper risk management. And that is why when we move on, my absolute favorite way to calculate my risk and to be able to adjust in the market, the pros on this one is that it is the most personal to you as a trader. So with the previous one, obviously we have some personal data that we're including, but with this one we have the most personal to us because we're taking our absolute worst case scenario and applying it to our risk management, which is what I think is the most ideal when you are trying to trade, because not only is it very straightforward, but it also allows you more freedom to capitalize on better setups with higher probability. And the reason why I say this is because even if you did want to go ahead and increase your contract sizing, you can still adjust your risk and contract sizing to meet the same framework in order to keep yourself in check with good risk management while also being able to enter with better trades. If you have higher conviction on certain setups, you are able to do that. Also, one of my favorite things about this style of risk management is because it is so easy to calculate your sizing per trade. When we are trading NQ, which is what I typically trade, every single tick is $5. So this means if we're going based off of a certain amount of trades before we end up blowing the account, we're able to calculate very quickly how many contracts we can enter with while also maintaining good risk management, because the math is way easier to apply than the second one, but also we are able to enter the trades just as quick as we would be able to do with the second method. So with this one, you get the best of both worlds in my opinion. It's the most personal to you. You're able to enter your trades quickly, you'll be able to calculate your sizing per trade, and you're also adjusting to the worst case scenario for your trading, which means that the only con for this is that you could only blow the account if you somehow break your worst trading record. So unless you have some crazy week where you have no clue what you're doing, and all of your trading knowledge just disappears from you, you should not be blowing your account when you are using this risk management. And that is exactly why I find this to be my favorite, is because I know if I'm trading like a normal human being, I'm not gambling, I'm not over risking, I'm not doing any of that. If I'm just trading, unless I have my worst trading week of all time, I'm keeping my accounts and I'm fine. Now, obviously, there's going to be certain situations for each person, so some people might find it better to go ahead and use the calculating sizing per trading. Some people can't trust themselves to trade without having it logically mapped out for them already. And then there's also situations where people don't typically have their data mapped out. That's why it is so important to be journaling your trades as well. But then again, that is also why I like to use clean dashboards. Alpha Futures has a very clean dashboard. You can see all your trading statistics. So if you guys have an account with Alpha Futures, you're able to see your win rate, your trading statistics, your profit factors, everything about your trading you're going to be able to track if you are using Alpha Futures. That is why when I said in the beginning it is the better firm, is because you get more data, more statistics, and it is a lot more user friendly. So for any beginners, if you guys want to use my code AVAL on Alpha Futures, they have a very good dashboard for you to be able to implement all of this that I've shown you guys today. If you guys found this video helpful, I would appreciate if you guys can drop a like. Let me know any recommendations. I know this video is one of the most highly requested out of the last video that I posted. Everybody was in the comments saying make a risk management video, so I hope I was able to deliver for you guys. Again, I just want to be able to give you free value. I have a lot more education in my free trading course below. If you guys want to go check that out, make sure to go to the first link in the description. It is a completely free trading course. I have more modules in there, more teachings in there, all for you guys to just go consume for free value. My Instagram as well, I'm updating you guys on when my one-on-one mentorship opens up again. That is where I have 17-year-olds making multiple 5 figures in a couple of weeks. I have 20-year-olds, 30-year-olds quitting their jobs and just doing trading, because of the things that I've been able to teach them, and a lot of more situations where people are changing their lives with my one-on-one mentorship. So if you guys want to stay updated on when that opens back up, go to my Instagram and I'll be updating you guys as soon as that happens. Also, after my biggest trading month ever, I just bought a new car. I literally have the paper for it right here. This is the down payment that I put on my new car. So when you guys want to go check that out, go to my main YouTube channel, the link in the description, and everything that I've already talked about as far as discounts and everything like that is all in the description. So other than that, I really hope you guys enjoy this. Make sure to subscribe if you want more videos like this. Comment down below what you guys want me to make next. I hope to be seeing you guys very soon.